الله أكبر الله أكبر، أشهد أن لا إله إلا الله، أشهد أن محمد رسول الله. حي على الصلاة، حي على الفلاح، قد قامت الصلاة قد قامت الصلاة. الله أكبر الله أكبر، لا إله إلا الله.
الله أكبر. الحمد لله رب العالمين، الرحمن الرحيم، مالك يوم الدين. إياك نعبد وإياك نستعين، اهدنا الصراط المستقيم، صراط الذين أنعمت عليهم غير المغضوب عليهم ولا الضالين. يا أيها الناس أنتم الفقراء إلى الله والله هو الغني الحميد. إن يشأ يذهبكم ويأت بخلق جديد، وما ذلك على الله بعزيز. ولا تزر وازرة وزر أخرى، وإن تدع مثقلة إلى حملها لا يحمل منه شيء ولو كان ذا قربى. إنما تنذر الذين يخشون ربهم بالغيب وأقاموا الصلاة. ومن تزكى فإنما يتزكى لنفسه وإلى الله المصير. وما يستوي الأعمى والبصير ولا الظلمات ولا النور ولا الظل ولا الحرور. وما يستوي الأحياء ولا الأموات. إن الله يسمع من يشاء، وما أنت بمسمع من في القبور. إن أنت إلا نذير. إنا أرسلناك بالحق بشيرا ونذيرا، وإن من أمة إلا خلا فيها نذير. وإن يكذبوك فقد كذب الذين من قبلهم، جاءتهم رسلهم بالبينات وبالزبر وبالكتاب المنير، ثم أخذت الذين كفروا فكيف كان نكير. الله أكبر. سمع الله لمن حمده. الله أكبر. الله أكبر. الله أكبر. الله أكبر. الحمد لله رب العالمين، الرحمن الرحيم، مالك يوم الدين. إياك نعبد وإياك نستعين، اهدنا الصراط المستقيم، صراط الذين أنعمت عليهم غير المغضوب عليهم ولا الضالين. ألم تر أن الله أنزل من السماء ماء فأخرجنا به ثمرات مختلفا ألوانها ومن الجبال جدد بيض وحمر مختلف ألوانها وغرابيب سود ومن الناس والدواب والأنعام مختلف ألوانه كذلك إنما يخشى الله من عباده العلماء إن الله عزيز غفور. إن الذين يتلون كتاب الله وأقاموا الصلاة وأنفقوا مما رزقناهم سرا وعلانية يرجون تجارة لن تبور ليوفيهم أجورهم ويزيدهم من فضله إنه غفور شكور. الله أكبر. سمع الله لمن حمده. الله أكبر. الله أكبر. الله أكبر. الله أكبر. الله أكبر. الله أكبر. سمع الله لمن حمده. الله أكبر. الله أكبر. الله أكبر. الله أكبر. الله أكبر. سمع الله لمن حمده. الله أكبر. الله أكبر. الله أكبر. الله أكبر. السلام عليكم ورحمة الله. السلام عليكم ورحمة الله. Assalamu alaikum wa rahmatullahi wa barakatuh. Few announcements. First announcement is that tonight, instead of having our regular nightly program, we have a guest speaker on behalf of Saturna Capital, and he's going to introduce himself in a moment and tell you a little bit about that program. That's going to be after the Sunnah and Witr. For those of you who weren't here in Salatul Jum'ah this afternoon, we made an announcement that starting from Monday morning, Salatul Fajr, inshallah, after consulting with the group of physicians who have been guiding us in regards to protocol during this pandemic, it has been advised and decided that starting Monday, there will be no gaps in the saf. However, and the option bringing a prayer rug and a sajada will be at your discretion. It will be optional moving forward. What does not remain an option is the face mask. So please observe that when you come to the masjid. And inshallah, Monday morning, Salatul Fajr, we will start praying shoulder to shoulder, inshallah. We ask Allah subhanahu wa ta'ala to unite our hearts. And we ask Allah subhanahu wa ta'ala to put these days behind us and better days ahead of us, inshallah. And Brother Munim, I'm going to invite him, and he's going to introduce himself and the program, inshallah. This will be after the Sunnah and Witr prayers. For those who would like to benefit, please attend.
Assalamu alaikum wa rahmatullah. I just want to first of all thank the masjid for allowing me the opportunity. Inshallah, what I want to do after the sunnah and the witr prayer is to really just go over as we're coming into the year end. When it comes to investments, there are some strategies that you can use to be able to save some taxes. How you can benefit the masjid with your donations of stock or mutual funds. At the same time, how you can benefit yourself as well. So probably 20-30 minutes I'll speak. And then I'll turn it over to Guidance Residential, and they'll speak for about 15-20 minutes or so as well regarding their Islamic financing program for homes also. So please do stick around, inshallah. I'll be happy to answer questions afterward also. Jazakallah khair. Assalamu alaikum. Assalamu alaikum wa rahmatullah. Should we get started? Inshallah. Bismillah, alhamdulillah, salatu wassalamu ala rasulillah. In the name of Allah, all praise is due to Allah. Present blessings be upon His Messenger, Muhammad sallallahu alaihi wasallam. First of all, as I began last time, I wanted to say Jazakallah khair for the masjid for allowing us the opportunity to come and speak here tonight. Hopefully, it'll be beneficial for you, what the presentation I'm about to give. My name is Moneem Salam. I'm the Executive Vice President of a company called Saturna Capital. And Saturna Capital is the investment manager for the oldest and largest Sharia-compliant fund in the U.S., known as the Amana Mutual Funds. So, as we're getting closer to the end of the year, there are some, if you already have some investments, there are some tax strategies you can use to be able to maximize your tax savings. And also, if you don't have investments, then there are some strategies you can use to be able to take advantage of the year end before December 31st. So it's a very short, maybe about 10 slides of a presentation. And as I'm going through the presentation, inshallah, if there's any questions for clarification, please don't hesitate to stop me and ask. If there's anything you might think might be a discussion item, we can always leave it towards the end and we'll answer them. And as I mentioned to you also, after my presentation is done, I'm going to have, it's my honor actually to have my father present on Islamic home financing through Guidance Residential, inshallah. Okay, so as I mentioned, this is what we're going to do. There are some things basically to go over, right? All investments have risk. That's part of the Sharia compliant nature of the investments that we have. What I'm going to be going over, as I mentioned to you, is I'll start off and talk about it from a perspective of, if you have things like an IRA or employer plans, education accounts, then what you can use to be able to save some taxes. And then if you already have and you need to be able to make some donations, what you can do after that point as well. The first part that I wanted to mention is going to be on traditional IRAs. Now, traditional IRAs are such that you can put away up to $6,000 per year into a tax-deferred account. Okay, so what that means is that for every $1,000 that you put in, and you can put a minimum, it doesn't have to be that's not the minimum, but just to keep the example simple, if you put $1,000 in, whatever your tax rate is, that's what you can actually save when it comes to your taxes. So let's supposing you're in the 25% bracket as an example. So for every $1,000 you put in, you're going to save $250 in taxes. Okay, and so you can put in up to $6,000. If you're above the age of 50, then you can add another $1,000 to it and be able to put it in. Now think of the IRA, the traditional IRA, as just basically like an account, and you're going to put the money in, and then you're going to decide what you want to do with it. Now you can open up an account anywhere. You can open up at a bank account with an IRA. You can do another like a regular Fidelity account, those type of things. Or you can open it up with the Amana Mutual Funds. When you get choice, and if there's nothing else that you get out of this presentation, it's important to remember that when you have a choice, you can choose to make your investments in a halal way. If you go to the bank, they're not going to give you a choice. They're going to just put it into a CD or some kind of a bank account, and you're going to get that rate of return. Also, so what happens is you put the money in, as I mentioned to you, it's tax deferred, right? So you're going to automatically save taxes. And then as the money grows, it's going to grow tax-free. So for example, any dividends that come out of your investments that you make, if you buy an investment, sell it later and then buy another one, and those are capital gains on it, there's no taxes on that. And then when you take the money out, then there is, you have to pay taxes on it. And if you take it out before, for 5 reasons, and if it's not for these 5 reasons, you're going to be also not only taxed on the gains or taxed on the entire amount, but also 10% of a penalty that you'll have to pay. And those 5 are retirement, which is 59.5 or above, major medical expenses, disability, first-time purchase of a house, or higher education. So for those 5 reasons, you don't have to pay 10%, but you do have to pay the taxes. Why? Because when you put the money in, you save the taxes. And so when you take the money out, you have to pay the taxes. Okay? And then so, usually they're very, very cheap to be able to administer and those type of things. And that's why you can actually choose your investment. And so when you open up with Saturna, and you can put it into the amount of funds, then obviously the money will be growing in a halal way. Now, so that's the first type of investment. So how is this going to be a tax year and strategy? Right? If you put away the in the entire $6,000, you probably end up saving in the 25% bracket about $1,500 in taxes. Now you can open up one for yourself and one for your spouse. Okay. Now, if you have an employer plan, either a simple or SEP or a 401k, and you're doing it for yourself as a plan, then you're not allowed to put any money in the traditional IRA. So it's either one or the other. But if you're doing it in a 401k and your spouse doesn't work, or she doesn't put into a 401k, or he doesn't put into a 401k, then you can open up an account for them and be able to save the $6,000 with a $1,000 catch-up. Okay. The opposite of that is going to be, again, this one was save taxes now, pay taxes later. The other option is to be able to pay the taxes now and to save the taxes for later. That's the opposite way of doing that. And this one is basically, it's non-taxable contribution. So whatever you put in, you've already paid the taxes on it, you're not going to get any immediate benefits. However, you are going to get it as a tax-free growth, and when you take the money out, you can take it out tax-free as well. Again, $6,000 to put in for you or your spouse. If you're above the age of 50, you can put in an additional $1,000. And then there's, again, no income tax on the distribution. Okay, so as it grows, you won't have to pay taxes. When you take it out, you don't have to. For the same 5 reasons. Retirement, which is 59.5 or above. Major medical expenses, disability, first-time purchase of a house, or higher education. So this one, if you wanted to actually put the money into your own name, into your spouse's name, and then use it for your own later on, getting a master's or PhD, your children's education as well, as they get into a college, they can actually do it as well. The other thing which is important is as your children get to the age where they're working, like for example, they might have a summer job or just a part-time job in high school or maybe in college, you can take that money and you can put it into a Roth IRA as well, and even a traditional. But the Roth IRA for younger children works a lot better. Okay, because the technicality is I said 6,000, but it's 100% of your income up to $6,000. So if your children only make $4,000 that year, you can only put in $4,000 for them. Okay, so 100% of your income up to $6,000. Again, it's self-directed. So when you open the account, you get to choose the investment that you want to make, and you can choose from individual stocks. You can choose halal mutual funds, whatever it is that you want to do. Okay. Now there's another difference between the two, traditional and the Roth. The Roth IRA, you don't ever have to take the money out of the account. So when for example, you can be 90 years old and you can still contribute to the Roth can continue to grow. Once you pass away, it goes to your spouse tax-free, and then once she or he passes away, then it goes to your children tax-free. The account will always remain tax-free. In the traditional IRA, right? It's the wrong way. In the traditional IRA, what's going to happen is that at 72.5, you're going to be required to take the money out. It's called a required minimum distribution, even if you don't need the money. Even alhamdulillah, you're strong, you're fine. Maybe you're on a pension, you have Social Security, whatever it is. Even if you don't need the money in the traditional IRA, the IRS is going to force you to take the money out. And the reason why they do that is because you've already saved the taxes, right? So they want you to take the money out, so you eventually have to pay the taxes. So that's kind of the idea of that. Yes. So it used to be 70.5, but in the last, I can't remember the law that came out a year and a half or two ago, they changed it to 72.5. So they added 2 more years to that. Okay. Any other points of clarification? Okay. So once we've done the Roth, the other one that I wanted to talk about is your employer plan. Now you might already have one, and you might be contributing to it. But another way to be able to save taxes is to be able to maximize the benefit of your employer plan. Now, a lot of times what happens is that this is established by the employer. So you're not going to get a lot of choice as to where you want to put the money, because they're going to have investment limits on it, meaning that they're going to choose what are the 5 or 6 or 10 or 20 different investments that you can make. And sometimes they can choose to make matching contributions, or sometimes they don't. And in fact, majority of 401ks, minus the larger companies, the small companies that have it, majority of them actually don't match your contributions. Okay. However, it allows you to put in more money away, which is 19,500 for 2021. Okay. And so for the 19,500, again, it's the same thing as the traditional IRA, where for every $1,000 you put in, whatever is your tax rate, that's what you're going to save on your taxes, meaning it reduces your adjusted gross income by that amount. Again, because it's going in saving taxes, it's going to grow tax-free, but then when you take it out, you're going to have to pay taxes on it. And the other thing is sometimes some 401ks have a Roth option, so you might think about doing that as well. Now, you might have a 401k, and you might say to yourself, you know what? There's no halal options that are there, and that's possibly true. So then you have to make the decision whether or not you want to put in a 401k or you want to put it into an IRA. So there's two things I want to talk about before we get into that discussion. The first one is that sometimes what happens is that a lot of 401ks in the larger companies have what's called a brokerage option within your 401k. And in that brokerage option, if you have that, then you can open that up within your 401k of the company. And then once you do that, now you have available anything that you want to buy in the market. Again, choice means you can choose to make it halal. So if you have that brokerage option, then you can choose to be able to buy something which would be halal in the market. Okay, so that's the first thing that I wanted to mention. The second thing is you can always go to your employer and you can lobby for them to be able to add the brokerage option to it. Ideally, you'd say, you know what, you just add the amount of funds, but likely, that's the chances of that happening is slim to none. But there is a very, very good chance that we've worked with a lot of companies that have actually added the brokerage option so that the people could buy into halal options. The second thing that I wanted to mention in regards to that about employer plans and those type of things, right, is that nowadays it's like it's a job seekers market. The person is looking for the job, they're in control. So I would encourage, for you to be able to, as you look at the benefits of a company, whether they offer you healthcare, whether they offer you whatever it is that they're offering you, one of the things that you should ask them is, what are the options in your 401k, and why do you or do you not have a brokerage option for me to make my investments in? It's a very valid question because you're not the only one. There might be other people that are working for the company that don't like the options in the 401k. So this is an encouragement for you to be able to do that. Now, if your company doesn't match, right, then what I would recommend is not do the 401k unless you're going to maximize at 19,500. Don't do the 401k and only do the traditional IRA to be able to get the tax benefit. And the reason is, again, because you have choice in what kind of investments you want to make. Okay, so that's the employer plan. There are other types of plans that are there also. There's a simple IRA. There's a SEP, which is called a self-employed pension IRA. Those both have different rules, but they're also the same lines when it comes to taxes, which is you save the taxes whenever you put the money in. Okay, are there any questions on either employer plans, traditional IRA, or Roth IRA? Yes, let's go in the back and then I'll come back to you. Go ahead. Okay, so this self-directed IRA, there's actually no fee for opening the IRA. Yeah, so when you put the money in, then you choose the investment, right? So in the choices, we have 4 options to choose from the 4 funds that we have, with a growth fund, income fund, emerging markets, and then basically a halal income fund called participation fund. So in those, there are separate fee schedules for each of those funds. They roughly range between 0.65% to about 1.1%. Depending on which fund you choose. Okay? Yeah, that's a different type of an IRA. Yes, you're absolutely right. That is a self-directed. There are very, very few companies in the US that offer that, but they do offer it. And you can do that. You can buy real estate with it, or any kind of investment that would be qualified by the IRS as an investment. Brother, did you have a question as well in the front? Did you have a question? Sorry, can you? Yeah. No. So what you're asking is what about the spouse? Yeah, you can easily, if you don't go for a 401k, you can open up a traditional and your wife can as well, or your spouse can. The only time you can't open a traditional is if you have a 401k already. That you can't do both for yourself. So if your wife doesn't have one or she doesn't work, then you can open up a traditional IRA even if you have a 401k. Same conditions, right? Okay, let's go here and then I'll come back. Yeah. Okay. Yes. Okay, so that's called a rollover IRA. Okay, so basically what you do is you take your old 401k, you open up a IRA, and you move the money over. There's no tax consequences for doing that. Once you've done that, then you can go ahead and invest it in any of the 4 funds that we have to make the investment. No, the Roth. If you go from a 401k to a Roth, you'll end up paying the taxes on the conversion, because again, it's coming out of that tax-free shelter. But if you go from a traditional, from a 401k to a traditional IRA, then there's no tax consequences for doing that. That's right. Now, I will tell you this, however, is that if you have money in your 401k and for whatever reason you've lost your job and you might be unemployed for, let's supposing you had a lower income this year, but inshallah it'll go up by next year, you might think about converting that traditional 401k into a Roth IRA and just go ahead and pay the taxes on it, because your tax rate at that year might be a little bit lower. So that's a possibility, but you should really think about doing that before you do. Okay, there was one here. Yeah, so the non-deductible is the Roth IRA. Okay, meaning that whenever you put the money in, you cannot deduct taxes, so it's non-deductible. That's the idea. You follow me? No, yeah. Okay, that's called a backdoor Roth. So that's what you do is basically you open up a traditional IRA, you put the 6,000, for example, and automatically you open up a Roth and convert the money over. So then you don't take the tax benefit on the traditional, and then you move the money to the Roth, and then you can let it grow. That's called the backdoor Roth. That's an official name. That's not okay. So it's called a backdoor Roth. And he mentioned an important point, which is that in a Roth IRA there are income limitations. So for example, if you're married and filing jointly, if you make over 190,000 a year, then you begin a phase out of how much money you can put into the Roth. By the time you get to 220,000, you cannot contribute anything at all. So there is a phase out for the Roth for that. Okay. Are there any questions else? Yes, Billy. Correct. As long as your income is less than the 190, then yes, you can. You can do both a 401k and a Roth IRA. And if you're doing it, let's supposing you're the single income earner in the family, then even if you do a 401k, you can do a traditional IRA for your spouse. Okay, because she would not have a 401k, then it's okay to do that. Or both of you can open up a Roth. No, for that one, she does not have to. No, but you have to have the income to do it. That's correct. Anybody else? Okay. Oh, yes. Sure. Correct. Generally speaking, I think the limitation is up to. Oh yeah, sorry, absolutely. Thank you so much. Totally forgot. I apologize, sisters. So the question was, is that if you, as I mentioned earlier, that you can take, you can convert from a traditional IRA to a Roth IRA. And the question was, are there any limitations on the amount of money you can actually transfer over? There used to be a limitation of 100,000. I think that limitation went away, but I'm not 100% certain on that. So you might just want to check with the accountant to actually kind of think about doing that. Anybody else? Okay, so so I talked about the income limitation. So now let's talk a little bit about on the education side. Again, it's going to be similar to what's called a Roth IRA. And as I mentioned to you, that in a Roth you can put the money in, and then you can let it grow, and you can save taxes on it, right? In the same way, there's another type of account called an education savings account. Now, education savings account, there is still an income limit, the exact same as the Roth, which is 220,000 for zero contribution. And then at the same time, you can put this money, again, after tax money going in, but it grows tax-free, and you can take it out for education. Now, there's a little bit of something to talk about education. Number one, you can use it for any education that you want. So, for example, if you have, your child is just born or your grandchildren are just born, if you put the money away and they end up 5 years or 6 years later going to Islamic school, you can take the money out to be able to use for that Islamic school as well. It doesn't have to be higher education. It could be any education. The second thing is that the definition of education is very, very loose. So you can be tuition, it could be books, it could be rental for their apartment, it could be a computer, it could be whatever you want it to be. So they're very loose definitions of exactly what that is. So it's very beneficial. However, it's only $2,000 per year per child. So it's a very small amount. But at the end of the day, so for example, the average cost of tuition, for example, if you go to UT Austin, over a 4-year period is roughly going to be about $38,000. Okay, so 18. If you contribute for your child for 18 years at $2,000 per year, how much is that? $36,000. So you should be able to still be able to pay for your child's education, inshallah, with the money that you put in here. And if you want to, again, you can supplement with a Roth, either for them when they begin to work, or even from your own Roth if you decided to do that as well. Okay. Again, there are contribution deductibilities. Now, if you don't use the money for the education, inshallah, they get a scholarship, and the scholarship was not only for books and tuition, but it paid for everything that you could ever possibly imagine, and you never take the money out of the account. If that happens, you can always transfer it to another sibling, or you can transfer it to a grandchild, or you can transfer it to anybody like a cousin or something like that. So there are some flexibility as to what you can do with the money. It doesn't have to be stuck in there. At the end of the day, if you don't want to do any of that, you want to just take the money out, then there's going to be a tax on the gain and a 10% penalty. Okay, so that's how that one works. Now, there are some a little bit older people in the audience. So I want to talk about the next strategy I want to talk about is going to be on if you already have money in a traditional IRA or a Roth, or you have investments that have gone up in value. Now, over the past, let's say, year and a half, right, most of the market is up more than 50%. So even if you had some money in the market, it would have some highly appreciated assets that are in there. So these are some tax strategies that you can think of that not only benefit yourself, but could also benefit the charitable organization, for example, the masjid. So the first one that I want to talk about is called a donor advised fund. Okay, the donor advised fund basically is it's a fund, but it's under an umbrella of a nonprofit 501c3 organization. Okay, so you take money or you take appreciated assets and you put it into this donor advised fund. Now, the reason why it's called donor advised is then after you've put the money in, you can take the tax deduction as if you had made a donation to charity, and then you can give it right back out to a charity, or you can leave it in there and decide whenever you want to be able to give the money out. In the meantime, and this is where the donor advice comes in, you can actually direct the fund to invest wherever you want them to invest. So, for example, there's one organization out there called the American Muslim Charitable Foundation, AMCF, and they actually offer donor advised funds. So we've been working with them. So if you open up through them, for example, they'll automatically put it into the amount of funds. The benefit of that is, let's supposing you have a tax bill coming up that you know about because of some highly appreciated assets. You don't know where to give the money so far. So you basically, from between now and the end of the year, you go ahead and put the money in there. And then all of next year, the year after that, you can decide where you want, what charity you want to go to. So that's one way of using that. The other way of using a donor advised fund is what's called a private foundation. It's an alternative to a private foundation. And the reason is because what you can do is you can begin to put money in there, and as it grows and grows, then you can get your family involved to basically think about what different charities they want to donate to. And then from the proceeds, or even from the actual account itself, you can take money out and you can give it to the charity that your children chose and those type of things. You're teaching your children about philanthropy, long-term philanthropy, and that's really the good thing. And the reason why I called it an alternative to a private foundation is that a private foundation forces you, excuse me, to take out 5% per year. In this donor advised fund, you don't have to take anything out at any time. You can leave it in there for the next 5 or 10 years if you wanted to, and then start taking the money out. So again, you don't have to choose a charity right away. You can wait, right? And then you can donate highly appreciated assets. So how does that work particularly? And you don't have to do it with a donor advised fund only. So for example, let's take the masjid here. As long as they have a mutual fund or a brokerage account, what you can do is, let's supposing you had $50,000 that you initially put in $10,000, let's say 5 years ago, and now it's worth $50,000. Right? You made some really good investments, and they went up in value. Now, normally you end up making $50,000 in donations on a year. So what you can do is, rather than giving $50,000 in cash and leaving that as a highly appreciated asset, because eventually one day you're going to have to pay taxes on it, right? Because when you sell it, you have long-term capital gains. What you do is you take your funds that are worth $50,000 and you donate it to the masjid automatically. Now what you've done is you've basically saved on selling of the actual security. The masjid sells it. They don't have any taxes because they're a 501c3. So now the taxes have been eliminated. But you're down $50,000 in investment. Well, if you normally make $50,000 in cash donations, take that $50,000, put it back into your investment account, and now you have a higher cost basis for your new investment that you have, that you were probably going to keep anyway. Does that make sense, what I'm saying? Okay. Okay. So from the beginning? Okay. So no, you don't. So let's, again, $10,000 investment that I made whenever I made it, it's worth $50,000 now. If I sell it and give it to the charity, right, I'm going to sell $50,000. That means $40,000 will have to be capital gains tax. Long term, 18%. Okay. Now, if I basically take that $50,000 of value and I just donate it to a charity, then you get the donation of $50,000. The charity sells that $50,000, but they don't pay taxes because they're a charity. Now you've saved the tax. You see what I'm saying? Now, because now you're maybe in your investment account, you're down, but because you didn't get it from your bank account, you have $50,000 more. So you take money from the bank, you put it back into the same investment. Now you've done is you've taken your cost basis from 10,000 up to 50,000. So then maybe when eventually you do need to sell it, and you sell it for 60 or 70, you're only paying on that 20,000 versus the 60, 70,000 of gains that you have. Does that help? Understand? Okay. So that's a great way to be able to make donations. Yes. It could be anybody, right? It could be any share 501c3. You can do it into a donor advised fund. You can do it into masjid. You can do it to Muslim Aid. You can do whatever, as long as it's a 501c3 U.S. registered charity. You can, and then they have a brokerage account or a mutual fund account. You can make that transfer into that account. Okay. Okay. Yeah. Yeah. And we're going to buy the same investment that you had because you had no intention of selling that investment, as an example, right? You were going to keep it for the next maybe 10 more years. So all you're trying to do is you're trying to increase your cost basis so that whenever you do sell it 10 years from now, you'll have a lower cost basis or a higher cost basis than you did when you initially invested it. There are two different money buckets. So let's, you have an investment account here and you have your cash account here. Okay? So you take your $50,000 bucket and you give it to the charity. Okay? Now your 50,000 went to zero. But you still want 50,000 in there as an investment, right? So now you take this bucket, which is your bank account. Normally, you were going to give that 50,000 in cash, right? So now you take that 50,000 and you put it into your investment bucket, right? That initial investment that you made from 10 that went to 50, that you would have had to pay taxes, now that initial investment becomes 50,000, and then it grows from there. And you also get a tax break on the new $50,000. So if, let's say 10 years from now, that 50,000 grows to 100, right? And maybe you decide that you don't need to replenish it now because, alhamdulillah, you're perfectly fine. Give that money to the charity, and again, you're going to save the taxes on the entire growth of that money. Okay, this is people do this all the time. It's a very it's complicated from an understanding perspective, but once you get it, I can guarantee you, hopefully, inshallah, you'll never go back to giving cash again, because it's a much better way to be able to make your investments. So I'll just give one more example for myself, right? So I decided that I've been working for the company for like 20 years now, almost roughly. So let's supposing 20 years ago I bought the amount of growth fund and I put $1,000 in there, and now it's worth from 1,000 and it went up to 5,000. Okay. Now normally, I went to a fundraising dinner for the masjid, and I really like the project they're working on, and say, I want to give $5,000 to the masjid. Now I have two choices, right? I can take it from my bank account, or I can take it from my investment account. Now, that's supposing my goal for the investment was to pay for my children's education. So if I give that to the masjid, then now my children's education account went to zero. But if I sell that investment to pay for my education of my children, it's automatically going to take a 15% tax penalty. So what I'm going to do is I'm going to take this 5,000 I'm going to give to the masjid. This 5,000 in cash, which I was going to give anyway, I go out and I buy it now. So I have a higher cost basis of doing that. Then when I give it, sell it to be able to give to my child for their education, I have a smaller tax bill than I did if it went from 1 to 5 or 1 to 7 rather than 5 to 7. You follow me? Okay, here, and then I'll go here. Yeah. Too complicated, I have no idea. I don't know. I don't know it's no or yes, I don't know. So I'm not a tax person, so that's a little bit too complicated for me to kind of think about and do. But that one, you can talk to your accountant and just ask him. Yes. The only way it works for your own nonprofit that I know of is you have a private foundation. Okay, let me go back and then I'll come back to you. Was there one here? Yeah, it could be right. It could be. I mean, technically, it could be highly appreciated assets, or it could be an art piece. It could be gold, but gold doesn't really go up and down, right? So it could be anything that actually it's highly appreciated. So, for example, you know what a lot of people use this for, and for the donor advice fund is, for example, they have they were in a startup, right, and now they're having a liquidity event because the startup's going IPO. Okay, usually there's a very significant capital gains there, right, because there's a valuation that's X-fold higher. So what they'll do is, sometimes what they'll do is they'll take some of those stock options and they'll put it into the charity, so they don't have to realize that taxability. Then when they exercise it in the DAF, right, they can still invest that money and then give it to charity later on if they wanted to. So that's one of the typical ways of doing it. Another way is what I just told you how to do it, which is you don't have a 10x jump, but you'll have a 1 or 2 or 3x jump, which is still pretty good. And you'll still save the taxes on that money. Okay? Now I'll come back to you. Sure. Yeah, that's right. Yeah, I mean, I just gave the example of 50. You can do it on 1,000 if you wanted to, but if you do it on $200, you might as well just pay the taxes on the 200, right? So there's a cutoff point where you want to say it's worth me saving the taxes to be able to do that. I mean, for you to do that, there's no cost to doing it. And for the like, for example, if you do it through us, there's no cost for us doing it. It's very easy. So even if you want to do $100, we can do it. But at a certain point, it does become burdensome to do it. So maybe not make it really small, but anything above a certain amount, just you can do that. I mean, anything, like I said, it could be stocks, it could be mutual funds. Some people have done art in the past. So anything that's eligible from the IRS perspective of being an investment. Okay. Sorry. Yeah. Absolutely. If Robinhood allows you to do it, yeah, definitely you can do that. Okay. Oh, sorry. You have to keep reminding me. I apologize. So the question is that what type of investments are allowed to be able to do the strategy that I told you, and is basically anything that's classified by the IRS as an investment. So it could be stocks, it could be mutual funds. Some people have done, like as I mentioned to you, art. Stock options is another possibility. So all of those things are possible to be able to do. Okay. That's up to them now after that. Yeah, they want to keep it. And I'll tell you, there are some very large charities in the US that have been doing this for the past 15, 20 years now, and they've kept those investments, some of them, not all of them. And so they've actually done really well. Or they could sell it and buy something else with it. Or they can sell it and cash it out and do whatever they want. So that's not, when you give it to the charity, it's no longer your money, right? So the charity has to figure out. If you want to control it, then put it into a donor advice fund, because then you'll decide what to do with that money. Yes. Yeah. So I mean, Fidelity offers one, Schwab offers one. They're all there. There's a lot of different donor advice funds. The problem is that when you put it into those, they're going to make the investments based on whatever they want to do. So it's not halal, right? So yeah, that's right. So the only one that's out there that's for the public is the one that I mentioned. It's AMCF. Yeah. American Muslim Charitable Foundation. Yeah, that's right. So that's the one that you can normally do. Now I'll close, and again we can take questions later. But I just wanted to put this up here, and that is that alhamdulillah, the amount of funds have been around since 1986. We have 4 different funds, and basically every single type of an account that a Fidelity or Schwab or anybody can offer you, we can offer you the same thing. If you already have a Fidelity account, a Schwab account, then you can buy our funds through them as well. Okay, so either come directly through us or go through them, perfectly fine. We do offer also, for those people that are interested, financial planning. We offer investment advisory, and also we do trusts when it comes to wills and trusts, and those for your estate planning needs. We will be able to do that as well, inshallah. Okay, so I'm going to close, and I'm going to turn it over to my father, Muhammad Salam, who's going to talk about Islamic home financing, inshallah. And then after that, I'll come back, and if there's any kind of remaining questions, I'll be happy to answer them. Jazakallah khair. Assalamu alaikum. You sure? Okay.
Assalamu alaikum. Bismillah ar-Rahman ar-Rahim. Alhamdulillah Rabbil Alameen. Salatu salam Rasul Kareem. Okay. My name is Muhammad Salam. I represent Guidance Residential, and I'm an account executive. I have been passing out the worksheet over there. Just put your name over there. We can send you email to. We can send you email to follow it up with your. I promise it's not going to market it. Just to our children here. The thing which I want to discuss is how Guidance Residential work. Okay, it's the only company. It does not have a bank. We are not a subsidiary of a bank. Also, it's an independent company funded by a group of people, and the chairman of that group is Muhammad Hamour. He's an 84-year-old guy. He has a big investment all over the world, all in Sharia halal investments. Okay, so the necessity was felt that how we can invest in guidance home financing for Muslims in America. And they found out that there was none. There were very few. They were not actually following the Islamic principle. So he actually gave a seed money from his guidance capital to Guidance Financial, and we were funded by Guidance Financial as a Guidance. This was back in 1999. It took 2 years for them to work out a program. So we hired Muhammad Taqi Usmani from Pakistan, okay, a very leading and renowned mufti. Along with him, he has 6 other people who worked for 2 years with 18 law firms to find out what's the best product for the Muslim in America. They studied Ijara, Murahaba, Musharaka, and they found that Musharaka was the best program for the Muslims because Ijara and Murahaba also allowed, but the way it is done in America, there was a little bit of a gray area. So they said they did not do that. So this company was formed in 2001 with 6 area board members. They're still with us. They've given fatwa. And they said, okay, there is no bank involved. We use our own money to finance the house with a customer. And the partnership is based upon the amount of money the customer pays. The rest is paid by us, our own money. We don't take money from anybody. We don't give any money, okay? So the partnership is based upon whatever the customer is putting as down payment, the rest is paid by us, okay? The salient feature about this is there is no prepayment penalty. Anytime you have the money, you buy the remaining shares of guidance, the house is yours. It could be second month, it could be after 5 years, but the term has to complete, okay? There's no extra fees involved in this one because there's no prepayment penalty. Also, there is no late payment fee. All the bank they do is they make their also profit on late payment fees. It is added to the principal, it compounds, okay? We don't do that. It's a very minimum fee, which is called admin fee, which is, we have to find out as to why the customer is not making the payment or whatever. So that fee is 5% or $50 capped off. It's not added to the acquisition, okay? So also in case of an eminent domain, natural disaster, or loss of income, loss of property because of foreclosure, we also take a share of the loss in this case. If you want, I can go a little bit deeper over there, okay? Give example over here, supposing the house is worth $100,000 at the time you purchase the house. And if you make a 10% payment, guidance will pay 90% payment and the seller is gone. So now LLC is formed. A limited liability corporation is formed between 2 of us, the consumer and also the guidance, okay? This is to protect the consumer himself because nobody can touch his house if he meets with an accident, God forbid. With these lawyers who are at 2 o'clock in the morning, they're watching for people who are meeting with accident. They will say, okay, he has got a house. We will sell the house, give the money back to you. They cannot touch his house. The other hidden advantage also, okay? So if the house is sold after 5 years for any reason, guidance will never ask you to sell the house. It's your prerogative. If the house is sold for 120, for example, and in these 5 years, you have acquired 5% more shares from guidance. But that from the original cost. It means now the partnership based upon 1585, correct? So you buy 85% of the remaining shares at the original cost. The rest is yours to keep. 120 minus 85 is how much? 35. Guidance will not take a single penny out of the profit which you make. Okay? The second question, the same example is, if the same house is sold for 90, again you have to purchase how much? 85% shares of guidance. In this case, what happened? You will get $5,000, guidance will get 85. And the last example, which is much more, that's the reason people come to us. If the house is sold for 80, it means guidance is at a loss of $5,000. There's a non-recourse clause in our program where to recover this money which we have lost, we will never go after the customer's private home or second home or investment home or even the bank. We are satisfied. We take a loss over there. In the losses, we take a loss, but in the profit, you keep the profit. And this is basically called sharakat al-milk. What we see generally is sharakat al-aqd, where two partners join hand, they take a loss or profit equally at the end of the year. Not in this case, okay? Because supposing, to example, if you're living in a house and after you have upgraded the house, you have built a pool in the house, for example. So why should guidance take the profit on the money which you have spent? That's the reason for that one. You keep all the profit, you just buy the share from guidance, and the house is yours, okay? So the main other thing is, because of the 7 Sharia board members which we have, they have never changed. They are the same thing. And they said, okay, anytime the law changes, you have to get approved from us. And fortunately, there have been no law changes, except that Texas is a different state altogether. We tried to open the office in Texas in 2001, and we got permission to open the Texas office in 2006 because they had never seen this partnership-based financial program for the housing. So we had to hire a lawyer from Houston, and they fought for 5 years, and they finally gave us the permission, okay? So this is just a little bit synopsis over there. If you have any particular question on the housing market, I'm able to explain to you. Yes, sir. Walaikum salam.
How guidance is making money out of this?
Very good question. When you make, like my example, we have to make 10% payment. The mortgage has 2 portions. One of them is acquisition. You acquire shares from guidance every month. Second thing is because you are using the portion which belongs to us. That's called profit. I call utilization, okay? So you're using the house which belongs to us. So you're giving rent, you can say utilization, but I say profit. That's the profit we make. And that's based upon the price of the house, the down payment, plus your score. Same criteria which are used in the banking system, but the process is different. In the banking, they give you money. In that money, they'll be adding the interest over there, and that interest is haram, okay? People say, okay, the same thing. It's not the same thing. I make a statement over here that it's always the process in Islam which makes the end result halal or haram. Okay, Mufti Taqi Usmani has written a very good book on this of Islamic Sharia financing over there. And he said that a chicken is a chicken, whether you buy from Kroger, HEB, or halal. What makes the difference? It is the process. If the process is followed according to Sharia and fiqh, the chicken becomes halal. If it's not followed, it becomes haram. So take the example of the house over here. Okay, the house is what? They're giving money. We don't give you money. We become partners with you. A product has to be involved to do business. Just to recap over here, there's only one thing which can involve a loan-based transaction, which is called Qarz Hasana. Have you heard about the Qarz Hasana? If Muhammad Salam needs $5,000 from you, for example, I will come to you. You can give me under 3 conditions. That's the only way you can give me halal money. That is, you're giving this money for the sake of Allah, number 1. Number 2, if I return the money even tomorrow or even after 100 years, I have to pay you how much? $5,000. If I cannot make the payment, you forgive the allowance. You forgive the amount over there. And that's the reason most of the masajid, they take Qarz Hasana from people. They return the money to you. That's the reason. That's the only way one can give money at the cash basis. Otherwise, a product has to be involved. It could be a house, it could be a business, anything. Okay? So that's the reason the process is totally different. Okay? Did I answer your question? Yes, sir. Very good question. No. I just told you, Our parent company is a $70 billion company all over the world. They are a big company from Syria. The chairman of the company is Dr. Hamour. He comes every year to US and give lectures on Islamic financing. So in 1999, when he was giving a lecture, a lot of non-Muslims were there too. So some Muslim approached him. He said, you have such a big business, you're a good Muslim also. What have you done for the Muslims in America? So he allocated the subsidiary of Guidance Capital, which is called Guidance Financial. From that, we got the seed money to form Guidance Residential. For 3 years, we were just using that money in developing the product. And the first product we have was purchased in 2001. That's our own money. And we still use our own money. That's our source. Now, if you come to think of it, you might be thinking about after a certain number of houses being purchased by Guidance, we get a cash lock. We cannot purchase anymore. So we were looking for investors. Any person, any entity who have $25 million, they can become Guidance investor. But that requires some trust. We don't trust them, they don't trust us. So, and this in 2001, when the company was formed, 9/11 happened. And the basic product was to sell this mortgage outside America. 2001, they stopped everything. So we had to look for partners over here. So we approached Freddie Mac or Fannie Mae. You know what Freddie Mac is? Freddie Mac was a company formed in 1970 to aid to be liquid for the banks and the mortgage to be liquid because they were cash locked over there. It was formed by the US government and it was purchasing only the mortgages. If I go tomorrow to Freddie Mac and ask for money, they will not give money. We're not in the business of them. They will take the mortgages from us, bundle it, sell in the open market to the New York Stock Exchange where you and I can purchase their shares. That's how they get the money. So we always get the money after we have sold the product to a customer and they sell it to the Freddie Mac. We get the money back. Did that answer your question? You have any more questions, sir? Yes, sir. Very good question. Commercial, as long as it is investment property, residential, yes, we can do that. Commercial lot, no. Because we form LLC. A commercial always an LLC or an S corporation or a C corporation. We can do that. And it requires more paperwork, and the Sharia board has not finalized that product over there because it takes a lot of scrutiny over there. We don't do anything, okay? No, shopping strip, no multiple family homes. We can buy individually, of course. You can buy a fourplex, okay, but not an apartment complex. Yes, sir. Okay. Very good question. The Texas law, and most of the state has a law, if you do not make a payment for 3 consecutive months, it's foreclosed. We have a very unique relationship with Freddie Mac. First of all, they refused us because they had never seen this program. Then they called us. So what's the benefit of doing business with you? So we told them this is a Sharia-based program over here. You cannot change a single clause of the contract. They said, okay, we accept that. But the restriction from us also. What the restriction was, if anybody default in our payment, you will have to buy back the contract from us. Okay? Freddie Mac has got authority to go to the customer, foreclose the house, not in our case. We will have to buy back the contract from them, and then we'll have to ask the customer from our side, what's the reason for that? Why haven't you paid? Loss of job, some family position over there. A committee is formed which will give the number of months not to pay the rent. Could be 3 months, 4 months, 7 months, we don't know. It depends upon individual and the committee which form over there. To give an example over here, the 2009 debacle of housing market, we were taking a loss of $7 million a month because we were delaying their payment, plus also this thing over there. This was basically the reason for that. So we were trying to help the customer out. Our rate of foreclosure was 2%, where the bank was how much? 14 to 15%. They were scratching their head. How come this small little company, Islamic-based company, what are they doing better than us? Because we were not asking them to throw the money out. They were being foreclosed. We didn't foreclose them. We gave them even a year of non-payment of any rent or the mortgage payment. You see, that's very critical. For example, one more example over there is, in Sharia, if a husband dies, the wife has to stay in the house for 4 months. Correct? Will any bank allow that? No. If you tell our office over there that the husband has died, she has to stay in the house, they will give you for 4 months to live over there. Of course, don't take advantage of it because the husband has left some money for the wife and the family. If you continue making the payment, no question asked. But in case if you have a bad situation over there, of course, we'll give some leeway over there. We don't have to make. Now, remember the Harvey, which happened in Houston about 3 years back? None of the customers which were with guidance, suffered that loss. Because of the partnership-based program, whatever the insurance gave them, we divided that money according to the share basis at that time. The bank, if the money was paid less, they kept everything. The first thing. Second thing also, we said, okay, we'll give you 3 months of no payment for mortgage. And also, we will not report this to the credit bureaus. No company will do that. Just because it is a Sharia-based, we have to take care of and the Sharia board members are very strict about that. Okay? They said, do not put any harm or extra burden on the customer if they cannot make a payment. Of course, we are a for-based company, not a non-profit company. Okay, it is for-based. We have to make some money. And there's a certain limit over there. Once the limit passes, we have to solve the house in foreclosure. Yes, sir. Okay. Okay, because we want investors. If we don't have investors, we are cash locked. Supposing you have $500 million in our account over there, we can buy 100 houses. After 100 houses are bought, we cannot buy the 101th house. We are cash locked. So we want to sell this product to our investor so we get the money back. And then we buy more houses. You know what I mean? That's the reason for that we have to have investors. Freddie Mac is only investors not before buying the house, after we have purchased the house. So if I buy before that, it's a loan base. They will not have money to give us any money. They are not in the buying and selling of money over there. So that's the reason we have to have Freddie Mac. And they refused that initially. They said, no, we cannot do business with you. So we had to tell them this is a Sharia-based program over here. The customer has to have some surety that's not going to foreclose. That's okay. We'll not foreclose, but you will have to buy the contract from us, for example. Now, the other thing very important is we only sell our shares. There's a hadith over there which says, do not make profit on the product you do not own. Correct? Out of this 100% house which you have purchased, only 85% of the house we own. How can we sell the other 15% to Freddie Mac? We don't own the product. Correct? So we only sell our product to Freddie Mac. They give the money back. And in case of a default, we have to purchase the same contract back from Freddie Mac to us. Then we'll take care of the customer later on. Yes, that's definitely a thing over there because they bundle the whole mortgages, sell in open market. then you can be confused over there, which is Sharia, which is not Sharia. They have not decided as of yet. When you buy the MBS, which is called mortgage-backed securities, that's a much more solid income for the Freddie Mac for them and for you also. Okay. Anybody question? Ask a question? Yes, sir.
Also, I have a question. What's the reason why the you call it, let's say, profit rate, right? Why the profit rate is a little bit higher than regular bank? What's the reason for that?
Okay. It is higher, 0.125 higher. Okay, it's higher because there's more paperwork involved over there. Sharia compliance has more paperwork involved. Okay, and because our investors are Sharia Freddie Mac, they dictate as the terms, the rate. That rate is a profit rate. If it's higher than the general market, nobody will buy product from us. If it's lower than that, we lose money. So it's commensurate with the market rate over there. But they decide as to what the rate should be. And usually it's equal to the other banks, like maybe Bank of America or maybe Wells Fargo, whatever, but it's 0.125, sometimes higher than that one, just because more paperwork involved. More paperwork, more filing of the taxes and everything. Okay? Anything else, brother? Thank you very much for that, and I really appreciate giving me a patient hearing over there. There are brochures outside. You have my card. You're free to take any. I have some card over here too. If you need, I can give you those cards and everything. And thank you for filling up the form. And yes, sir. I don't want to discuss anything what they do, but the thing is, they also do a Musharaka program, but it is not an LLC-based program. Okay? Because you have to pay a certain amount of money every month for the LLC to be registered and to pay taxes upon. We do pay taxes on that one. But what they are is basically, as I said, we are not a bank, not a subsidiary of bank, but that is. So when they form a ULC, they are bundling every part of the company, which is University Bank, in the product over there. So, but that's up to them to, but they are two different products over there. Okay. Thank you very much. Appreciate it.
Are there any questions from either of us before we close off the Salah? One question. Yeah.
I'm sorry.
So thank you for that. So the question was, is that, what are the different types of funds we have? And, how do we decide on what to buy and stuff? So let me talk a little bit about the Islamic investment angle of it first, and then I'll talk about the funds. So what we do on a monthly basis is we run a screen of all the stocks. Actually, we do it globally, but let's just say in the U.S. Of all the stocks in the U.S. And we run it first on a primary revenue screen. So the primary revenues of a company cannot be involved in anything that's haram. Okay, so no alcohol companies, tobacco, gambling, banking, insurance, like that. Then the second ratio we run through is quantitative. Quantitative means just the financial ratios. So one of them we're doing is the total debt to market capitalization. Okay, and that has to be less than 33%. 33. The second one is accounts receivables to total assets is less than 45. And then the last one is any other haram revenues as a percentage of total revenues has to be less than 5%. The third screen that we run is on an environmental, social, and governance level. And that basically is looking at what the company is doing when it comes to recycling of either their water, their waste, whatever it is, or carbon footprint, greenhouse gases, those type of things. On the S side, what they're doing as far as, if there's a manufacturing company, what their safety record is. If there are other kind of companies, what they're doing on the social and employee side relations. And the G is the governance. Do they have an independent board? Are they diversified? Is there a separation between the CEO and the chairman? Those type of things we're looking at. Once we run those screens, we have a grading system that grades it. Okay, that's on the the Sharia and the ESG side. Then our analysts look at it and first decide whether it's a good investment or not. After all of this is done, We have 4 funds, as I mentioned. So those that qualify as growth companies, they're not paying dividends. They're basically growing fast enough so they're taking their profits and reinvesting back. We buy that into the growth fund. So that's typically a higher rate of return. Over the past 10 years, we've averaged about 15% rate of return. The second one, which is our oldest fund, is the income fund. That we're looking at equity income, larger companies paying dividends, those type of things. That on a last 10-year basis is up about 9% per year. The third fund we have is a developing world, so emerging markets. So it's anything outside the US, or if it's US traded, then it has to have either 50% of their sales or their assets in emerging market countries. And the last one is participation. And participation basically is what's called a sukuk fund. A sukuk is, for lack of a better term, a halal income certificate. So we're buying globally those countries or companies that offer these halal income certificates. We're buying them. They're a good alternative to a bond. So it's a very stable fund. It's just giving you an income. It's good for your operating cash, or if you're retired and you want to save your principal, those type of things. So those are the 4 funds. We have a tool on our website called the Amana Selector. If you go there and if you answer about 8 different questions, it'll tell you, if you don't know which fund to buy, it'll give you an allocation based on your answers to your questions as to which percentage of each fund you should have. Okay? So it depends on what you're talking about. So for example, our fee on the growth fund is about 0.7%. Okay? So that 0.7%, we're an active manager, we do our research, that type of thing. So if you compare that to other funds our size, we're probably lower by about 10 basis points. So they're probably at about 0.8, we're about 0.7. If you're comparing it to, $100, $200 billion fund, we're probably going to be more expensive. But so that we're pretty much in our competitive area, we're either a par or below whatever the fees of other funds are. Okay, and all of this is available on our website. You can go there and check expense ratios, returns, everything is on there. Yes, brother. Yeah, so it's total debt to market capitalization. Has to be less than 33%. Go ahead. And the second one is the total assets. So accounts receivables to total assets is less than 45. And then the last one is just ancillary haram revenues. That it has to be less than 5% of total revenues.
Do you think do they follow these criteria?
They follow very similar ones. Yeah. So the thing is that if Zoya says it's not allowed, that doesn't mean it's not allowed, because it depends on criteria. But if they say it's allowed, it's usually allowed for us as well. So that's kind of how you have to look at it. It will qualify. But if they say it's not allowed, it could still qualify for us. That depends on the criteria. So that just depends. Okay. Look, so nobody's going to argue with you that these metrics are not valid. They might differ in the percentages. So rather than 33, they might say 30, or some go to 35. But the actual what the metrics are, there's no disagreement on that. It's tricky, but it's fundamental research. We actually have to call the company sometimes. You dig a little bit deeper into the financials. Sometimes we do extrapolate. So because some companies don't report their interest income. So then we go to the cash, we get the prime rate, whatever it is. We make our calculations, say, roughly this is what it is. And then our goal is to be 0. So we're not going to go 4.9, right? So that's kind of the idea. So, yes. We do ourselves. Oh, no, we have a Sharia board that audits us, right? They do it on a quarterly basis, and that audit is available on our website. Okay? But with the screens themselves, when they're run, we do it. And then they come and audit. Just like an accounting firm, like in accounting, you do the accounting yourself, then the auditor comes in and audits. It's the same thing. Okay? Was there one more question anywhere? Okay. All right. So inshallah, jazakallah khair for your time. And we'll close off with a dua. Subhanakallahumma wa bihamdik. Wa ashhadu an la ilaha illa ant nastaghfiruka wa natubu ilayk. بعد أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم والعصر إن الإنسان لفي خسر إلا الذين آمنوا وعملوا الصالحات وتواصوا بالحق وتواصوا بالصبر. السلام عليكم. بايك الحمد لله.
That's what I have done. So if they allow, that's 100%.
Yeah.
Pretty much.
Yeah. I mean, they're a trusted website. Sorry, there's nothing wrong with them. It's just because of the different criteria.
Okay.
It just depends on, whether or not we say yes and they say yes, and we say no.